Hello, this is Professor Hazara again, and this is one of the final videos for the MBA 510 course. I'm just making sure that the volume is turned up. One of these days I'll actually get myself a microphone when I get out of the house. Anyway, this chapter, chapter 9, this is chapter 9, and it really is how to make a budget for an entire organization. Okay, and I'm going to try to get started because I want to keep these videos short. It's going to be 3 videos. Now, in this chapter, and I'll put this in the email, we're going to concentrate on, there's 2 sections. One is how to make budgets for retailers. I'm not too interested in that. I'm more interested in how to make budgets for manufacturers. And that is going to, the topics on pages 323 through 331. I'll put this in the email. And I looked for a bunch of examples, but I think one of the best examples I've ever seen is one actually that's in the book. And that example is on pages 327 through 328. It's review example 9-4. So I think the best way to do this, and it's really comprehensive example of how to do a budget for a master budget, a huge budget for a manufacturing organization. It gives you an overview. So that's what we're going to concentrate on, and the homework problem will be revolve around that too, or variations. One sort of warning about this topic is that there's a lot of common sense in it, and there really is no single way to do it. The flow is basically the same in all the textbooks and companies you see and read about, whatever, but everybody does it a little differently. So even though the flow of the budget is going to be the same, the circumstances change dramatically sometimes. Okay, so anyway, so what I'm going to do in this video is I'm going to go over the data in the example. And like I said, this is on pages 327, 328, so you should be able to follow this, if you read those. I'm just trying to, seeing the video might clarify something for you. And then, so I'm going to go over the data in the example, and then I'm going to do the first 2 budgets. It's a series of budgets, basically, that an organization would do. I think that you might say there's 5 budgets or statements that you might prepare based on this. Okay, so anyway, so I'm going to go ahead and get started. Okay, and what we're going to try to do is we're going to try to make an internal budget for a manufacturing organization. Obviously, this is very basic. And then we're going to try to make out of that, once we do the budget, we're going to do, once we do the budget for the manufacturing process, then we're going to do a cash budget, and then we're going to do an internal income statement. And that's pretty much the process. Okay, so in this video, I'm going to give you the data, set up the example, and go over the first 2 budgets, which are very easy. Then there's 4 more budgets after that. I'll do the middle 2 in the next video, the last 2 in the final video. They all kind of go together. Okay, so this is example. Let me just shrink myself here. This is example, I would say it's review problem 9-4. Okay, and it is on pages 327 and 328 of your textbook. Okay, and I'm going to go ahead and see if I can pull that and put that in red. And you'll see that the solution to this, so I'm just going over the problem and the solution. You'll see that the solution to this is, I think, on pages 349 through 352 or 3 like that. So the only thing I'm going to do in this video is just set up the problem, and you can read about this. You can see the problem on page 327 of your book. And then I'm going to make the first 2 budgets, and then in the second video I'll do the second 2 budgets, and the final video I'll do the last 2 budgets. Okay, so this is an example of DeWalt, and if you do any homework, housework at all, any carpentry, you know that DeWalt makes power tools and stuff. Okay, and it's a subsidiary of Black & Decker. The companies make power tools, and I thought that was kind of neat, something a lot of people might be familiar with. Okay, and we're just going to assume that they have a new manager, and this manager desires to make a master budget, and this whole example is an example of a master budget, okay, for the first quarter of 2017. Okay, and I'm going to put here the data for the example. Okay, and so everything, let's just say this, and just so everything stays clear, The data for the example is basically the first columns A through I, and I'm going to go ahead and merge those so it is clear where the data for the example is. Okay, the data for the example is basically these columns right here. After we get out, this whole worksheet is going to work out to the right here. And so the data is going to be here, and then the first two budgets, the sales budget and the production budget of final units, is right here. Okay, so here's the data for the example. Now it's a power, and they make power tools. So this division DeWalt makes drills and maybe electric saws or saws. Okay, and these are budgeted sales. These are the sales they think they're going to make during the quarter. So keep in mind that everything here is not reality. It's your forecast of reality, budgets. Okay, so they think they're going to make 60,000 drills and 40,000 saws. Okay, in terms of dollars, this is sales price, really. This is, I'll put here, this is SP, which is sales price in dollars. So they think they're going to sell each drill for $100, and they think they're going to sell each saw for $125. Okay, now these are the inventories. These next two, this section here, these are the inventories. I'll go ahead and put this in red here, major sections. This next section here is, I can actually take this and just move it up here. And so this whole section here are their inventories here. Okay, so the beginning are for finished drills. These are drills. They make two products. They make drills and saws. So these are both finished goods inventory. Okay, and their beginning inventory is 20,000 units. I believe that's a fact for drills. And their beginning inventory of saws is 8,000. And the budgeted, the desired, you may want to put here desired ending inventory, because it is a type of budget. So in textbooks, it usually says desired ending inventory. They want to have 25,000 units of drills on hand at the end of the period, and they want to have 10,000 units of saws on hand at the end of the period. Keep in mind that these are both these here are finished goods. Okay, so there would be, if you were thinking of the chapter with job order costing, there would be finished goods inventory. Although I'm not sure this would be job order costing. Okay, and then we have these are your direct materials. So these, I'm just going to put here, these are finished goods. These first two items here are finished goods and finished goods. And these, the next three items are direct materials. They go into finished goods. So these next three items here are direct materials. They go into the finished goods. So you put metal, plastic, and handles into the work in process. And they come out as finished goods, either in the form of drills or saws. Okay, so these are finished direct materials inventories. These are the beginning ones. Now, the metal that goes in the products is expressed in terms of pounds. So the beginning inventory is 32,000 pounds, and the desired ending inventory is 36,000 pounds. Okay, then the plastic, you have plastic that goes into, I guess it goes into both drills and saws. Okay, and so the beginning inventory is 29,000 pounds. The desired ending inventory is 32,000 pounds. And finally, I guess handles, I think only in this example, if I recall, I just did it. Handles only go into one of these products. We'll see, it doesn't matter, but I guess saws, if they're not power saws, have handles that you go back and forth with. But they, for each handle, they have 6,000 to start with, beginning inventory, and 7,000 to end the period is their desired ending inventory of handles. Okay, now the next table here, we've got a few tables going down here. We've got a table and some assumptions here. Now, the next table here, in a sense, we may go through the chapter we're in, but these are basically per unit budgets that companies like to prepare. So you've got up here, these are sort of aggregated budgets. Here's your total drills, these are total saws, these are your total metals that you have on hand, your total plastics, and your total handles. But companies, what they like to use, they like to compare what are called standard costs, or a standard cost, which including both the cost per the materials and other prime costs that go into products, and the amount of materials that go into each product. Okay, so let's, for example, the company uses metal in both drills and saws. So the company says that to make one drill, you should have 5 pounds. I have to separate these up. You should have 5 pounds of metal. Each pound of metal should cost you $8. So the total amount of metal that goes into each drill should be $40, which is, I'll send you the sheet, but as you can see from the equation here, you can see it's 5 pounds per drill times 8. Okay, so that's kind of a standard cost, let's say, standard budgeted cost. Then we come over here to saws, okay, and saws are, for saws, the company, based on their experience, says that for one saw, 4 pounds of metal should go in. I guess the same type of metal at $8, so each saw should use up $32 worth of metal. And then the same thing for plastic. Say the company has a bunch of plastic, it uses it both in drills and saws. For drills, each drill should have 3 pounds of plastic going in. Each pound of plastic costs $5, so each drill should have $15 worth of plastic in it. And there's the same quantities for saws, so I guess the same amount of, let's get this right here. So the same amount of plastic that goes into drills is also the same amount and the same cost that goes into saws. So each drill and each saw takes up $15. Now here's what I meant before. Is I guess they have some type of handle that goes into drills, but not into saws. Okay, so they have a store of handles. Each drill only has one handle that goes into it. Each handle costs $3. Okay, so each drill should have a $3 handle in it. And for saws, the costs are 0. Okay, so the total, I should put here, total direct materials costs. These are the total direct materials costs that go into each one of these products. So $58 are your direct materials costs for, are your budgeted direct materials costs for drills, and $47 are your budgeted direct materials costs for saws. Keep in mind that your product costs are direct materials, direct labor, and overhead, manufacturing overhead. We're just going to use variable manufacturing overhead here. All these costs, direct materials, direct labor, and variable manufacturing overhead, are variable costs. Okay, so here's what we got here. And I'll go ahead. So $58 are your direct materials costs for saws and drills. Okay, and then we've got direct labor. Okay, now, so obviously any product has materials costs going in, but also has direct labor going into it, also has manufacturing overhead going to it. Okay, so what they're saying is that direct labor, that it should take 2 hours to make one drill. You're paying each worker $12 per hour, so $24 is your direct labor cost that go into drills. And then for saws, I guess saws are a little fancier. I think it would be opposite, but 3 hours that go into of direct labor that go into each saw. Then $16, you're paying each worker $16 per hour, so the total direct labor costs for saws are $48. Then your variable manufacturing overhead, which includes indirect materials and indirect labor, by the way. Variable manufacturing overhead. Now they're applying it on the basis of direct labor hours. If you remember from job order costing, is we don't put the actual labor cost into work in process. We apply it and then we adjust for that later. Okay, but anyway, so they seem to be applying manufacturing overhead on the basis of direct labor hours. So 2 direct labor hours go into each drill. and they've estimated that each drill uses $1.50 of indirect labor, indirect materials, and factory costs like electricity and all that stuff. So $3 of regular manufacturing costs are dedicated to each drill, and then it takes a little bit more. It takes 3 hours to make one saw, direct labor hours. Okay? And once again, they assume that they think that for each hour worked, $1.50 goes into a product, and so it's $4.50. Okay, so the total cost for each, I'm going to put here total unit cost, total unit cost for each one of these types of products. Just to get a bold. Okay, so the total unit cost for each one of these products to make one drill, it should cost, these are all budgets now, it should cost $85, and to make one saw, it should be $99.50. Of course, based on the last chapter, you could start marking things up there. Okay, now here's some other information in the problem, and this will probably mostly pertain to the last videos, but here's some of the last information in the problem, and you should see this on page 327 of your book. The company has a beginning cash balance of $1,800,000. Sales are on credit, so this company only sells things on credit, and they collect 50% of their sales for each product in the current period and 50% in the next period. Okay, the previous quarter sales were $8,400,000, no bad debts. Manufacturing orders are paid in the current quarter. So what they're saying is that they don't stretch their purchases of manufacturing overhead over many quarters. Everything is paid immediately. Selling administrative expenses are paid in the current quarter. They include currently $340,000 of cash expenses and $90,000 of depreciation, or $250,000 of cash expenses. And then finally, fixed manufacturing overhead is $340,000 for the quarter, including $156,000 of non-cash expenditures. Okay, so let's go ahead. Based on this, I'm just going to make the first two budgets, and so I'm going to go ahead and make the sales budget and the production budget. Now, these are all related to final units. We're not looking at budgets for direct materials or labor here or anything like that. These are all units, final units. Okay, and these are the two easiest ones. And like I said, master budgets can take many forms, but they always start with the sales budget, because unless you know how many units you're going to sell, there's nothing to budget. So you've got to have an idea from your marketing people how many units you can sell and would like to sell. So let's make these two easy budgets. I'll stop this video, and then as you can see over here, I'll go into these more extensive budgets here in the next video, the purchases budget and the manufacturing budget. Okay, so let's go ahead and right here, we'll make our sales budget. And this is pretty easy because all we're doing is repeating numbers here. So we're saying here that drills, our marketing department says that we should be able to sell 60,000 drills, and we should be able to sell 40,000 saws. The price per drill is $100. The price per saw is $125. Okay, so your total sales of drills, your total sales in cash should be $6 million for drills, and your total sales for saws should be $5 million for saws. And I'm going to put here total sales. It really is total budgeted sales, but well, I'll just put total sales. The whole understanding in this video and in the chapter is that everything's budgeted. Okay, so our total sales that we anticipate to make is $6 million plus $5 million, or at $11 million. And obviously, the last step in this whole thing is going to be I'm going to make a budgeted income statement, and of course, this is the top line of that. Okay, now let's do a production budget. Okay, and I want to emphasize that this is a production budget of final units. So we know how many units we're going to sell. Now we've got to figure out how many we have to produce. And you may be asking yourself, well, if we know we're going to sell 60,000 of drills and 40,000 of saws, don't we have to produce them? Yeah, that's true, but you also have beginning and ending inventories that you have to adjust for. You have a beginning inventory and a desired ending inventory that you have to account for. Okay, so here's what we've got. Here's our production budget, and you're going to see that this logic is like the cost of goods sold logic in accounting, or BUS 503 in basic accounting. It's you're going to add a couple things up, take out the beginning inventory, and that's what you're going to need to make or sell or whatever. Okay, so our budgeted sales. Okay, and we're going to do this in terms, and you notice it says in terms of final units here. Okay, so our budgeted sales for drills is 60,000, and the units that we're going to sell is for saws is 40,000 saws. Okay, then we have our desired ending inventory. I'm going to put here desired, just so it's clear, desired ending inventory. Okay, and we will extend this a little bit here. Okay, so our desired ending inventory is these numbers right here. We want to have on hand at the end of the period 25,000 units of drills, 25,000 drills, and we want to have on hand for saws at the end of the period 10,000 saws. Okay, so these are your total inventory, and let's be clear about this. I don't have too much space here. These are your total inventory requirements. So these are your total inventory requirements here. So what we're saying here is that you've got to have enough to sell 60,000. You've got to have enough inventory to sell 60,000 drills and 40,000 saws, and you want to have certain numbers of these drills and saws in place. So your total requirements, your total inventory requirements are what you're going to sell plus what you want in your ending inventory. So you want to have 85,000 units, 85,000 drills on hand, and just copying that addition over, you're going to have 50,000 saws on hand at the end of the period. Now, obviously, if those are what you need to have on hand, if those are your total inventory requirements, if you take out your beginning inventories, then that's going to give you your budgeted production, how many units you have to produce. Okay, so our beginning inventory for drills is 20,000. Make that negative. And then I'm going to go ahead, our beginning inventory for saws is 8,000 units, and that's negative. Okay, so this is the number. Let's put it budgeted production. These are the numbers of units that you're going to have to produce this period in order to meet both your budgeted sales and your desired ending inventory. Okay, so your total requirements are 85,000. You already have on hand 20,000. So your total production, total units needed to be produced. I've seen books that call this needed to be produced, which is a better way to put it. I'm just using this book's language. But the total units needed to be produced are 65,000 drills in this case, and the total units saws that you need to produce are 42,000 saws. Okay, so I'm going to leave with those two numbers there, because these two numbers are going to be the basis for the two budgets that are coming in the next video, which is the most involved, even though a lot of this is just common sense. And you're going to notice that this type of logic of we're going to sell so many, we want so many on hand, those are total requirements, less what we have on hand, that type of logic, which is kind of like cost of goods sold even, is going to be used throughout this. Anyway, so I will put this video on YouTube, and there's going to be two more videos. I'm trying to keep these videos less than, let's say, in the 20 to 30 minute range maximum. Okay, so anyway, thank you very much, and I will put up this video, and then I will put up the next two videos. Thank you very much. Bye-bye.